I guess this is supposed to be something to be excited about for gold bulls, even if we have nearly 38 trillion in hard U.S. debts and hundreds of trillions in unfunded liabilities to come in time.
Reports suggesting the U.S. Treasury's gold reserves are now valued at over $1 trillion at the current market prices. Now, that's a figure that's 90 times more than their official balance sheet value. The substantial gain is a result of gold's remarkable 45% surge in 2025. Other precious metals have also seen significant gains. Silver has been a standout performer, rising by 53% this year, while platinum is up around 50%. Palladium up around 39%. The primary drivers for this rally across precious metals being a combination of geopolitical instability, economic uncertainty, and central bank policies. Global trade conflicts and geopolitical tensions have also led the investors to seek the traditional safe haven of precious metals. At the same time, the Federal Reserve's resumed interest rate cuts have weakened the US dollar, making these commodities more attractive to international buyers. Other central banks around the world have also been actively increasing their gold reserves to diversify away from the US dollar. And looking ahead, financial institutions have varying projections for these metals. Several major banks anticipate gold's upward trajectory to continue, with some setting targets higher than $4,000 per ounce. For silver, its dual role as a precious metal and an industrial commodity is a key factor. Analysts expect more upside for silver as it is supported by demand from the green energy sector, including solar panels and electric vehicles. Platinum, for that matter, also expected to benefit from the industrial demand, while palladium faces some headwinds from substitution with platinum. While the value of these tangible assets has increased, experts are also saying that this is a signal of growing distrust in traditional financial instruments.
Even Goldbug Sachs' spring 2025 call for near 4,000 an ounce gold, and perhaps beyond by 2026, that's starting to look a bit conservative. Let's look around the world, being revalued by gold to the tune of 136 full fiat currency nominal price high records late this week. Not to be outdone with a slowly falling spot gold-silver ratio, the world's nominal fiat silver record price highs are now hitting in 121 nations around the world. Even precious platinum is getting in on the nominal price record high act, with 44 recent nominal record price highs likely in nations suffering from the most outsized relative fiat currency devaluations when compared to the likes of the fiat US dollar or the fiat Swiss franc, for example. Platinum's all-time nominal price high of near $2,300 an ounce was hit in early March 2008, right before Bear Stearns went bankrupt and later Lehman Brothers, Infinite QE in the 2008 GFC implosion that followed not long afterwards. Now, somehow the Western world, when compared to the likes of China, India, and other nations in Asia like Japan, they are still relatively asleep at the wheel when it comes to gold and precious metals related bull markets ongoing. The West doesn't have dramatic capital inflows into unsecured gold, silver, and other precious metals related ETFs and ETPs yet. You can see evidence of this all over their media outlets from China to India to Japan and beyond in Greater Asia. And judging by US Mint sales data of fresh gold and silver bullion coin products, you can see how tepid the domestic US market is in buying new line bullion coins now versus early in the 2020s. I know nominal prices seem high now, but I'm still buying bullion. On a relative basis, silver and gold have a lot of work still to do, melting down bubble markets around the world in real value terms. Lease rates out of London continue suggesting their precious metals market is not only tight, but perhaps may eventually hit backwardated walls akin to how the global coffee market is currently trading, meaning the spot price may eventually climb above all futures price in an effort to get some bullion to come back to make markets in the seemingly lawless city of London. Quarterly price charts for silver are in, and Q3 finished at a bullish level, just below the seemingly ancient nominal price high of 50 fiat US dollars. More on that mark in the second half of this week's SD Bullion Market update. When we look around the world at other current commodity prices relative to their old 1980 nominal price highs, there is still near nothing as relatively cheap as silver bullion currently is. The fact that silver in fiat Swiss francs still needs to nominally double to meet its old 1980 nominal price high and then much higher fiat Swiss franc values, that gives me confidence that this building bull market in silver will likely go up and down in the history books as the all-timer by far. Operating from a view that silver has been systemically suppressed for over a century of time following our nation's civil war in the mid-1800s, we are truly on the cusp of an interesting new pricing paradigm for silver around the world to come. So stick around. On the other side of this break, we will break down just how crazy gold and silver price prognostications are getting with timeframes that are even tighter than I even dare suggest on this channel. We'll be right back. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Yeah, and I think since we've launched the SD Bullion IRA program, we've even gotten more insight into this industry.
Right.
And you start to see like the email, the unorganization, and things make sense of why things take so long. When you use the traditional three, separate entity model, nobody's doing checks and balances with each other.
And like you said, there's horror stories now that that people are reaching out like, hey, the depository says 4 years ago they didn't get this inventory, and it's like this is crazy, guys. Like compared to our facility, everything, literally every inch of this facility is under camera.
I hope you enjoyed this short clip from my recent conversation with SD Bullion founder Dr. Tyler Wall. If you're interested in opening a gold or silver retirement account, then this video is a must-see. The insights and strategies that we reveal have helped SD Bullion customers save hundreds of thousands, if not millions of dollars inside their gold and silver retirement accounts. After $5 billion in transactions with more than 400,000 customers, I assure you, this video might be the most important thing you do for your gold and silver future. Visit ira.sdbullion.com/video today. There, you'll be able to gain full access to the entire interview, and you'll also be able to watch more short clips from our conversation. That's ira.sdbullion.com/video. I hope to see you there.
The silver and gold markets re-rated higher again on the week. The spot silver price ended the week just under 48 an ounce bid, and the spot gold price ended at just under 3,900 an ounce bid, with the spot gold silver ratio attempting to fall lower, finishing at a still historically high level of 81. The Discovery Alert website out of Australia had an interesting post this week suggesting that the forecasted figure for net central bank official gold bullion buying tonnage for this year 2025 will again break record high levels in weight, suggesting that over 1,300 metric tons of gold bullion will be bought by central banks collectively, with nations like Poland, India, and China leading the charge. It's a well-written article, and I will leave a link in the back show notes below of this YouTube channel posting of this video. Pierre Lassonde of Franco-Nevada fame made headlines this week with a ridiculously sounding bullish gold price call by 2030. He also had fond words for silver slingshot bulls, who will agree in saying it sounds terrific, from this Wealthian clip backlinked in the show notes as well.
Right. And before we change directions a little bit, I just interpolated from what you said about being in 1976, sort of what inning are we in? That sort of implies that you wouldn't be surprised if gold exceeded $10,000 an ounce over the next 3 years.
No, actually, yesterday I gave a speech at the Grants Conference in New York, and I predicted that we will see gold at 17,250.
And did you put a time frame on that, or that's just
Between now and 2030.
wow, incredible? Was there a murmur in the room?
Yeah, sort of. Some people don't quite believe me, of course. And I know it's hard to comprehend.
Right.
But when you've lived through the 1970s, it was hard to comprehend $800 gold as well.
Right.
Okay. And what happens is a bit of a mania in the last 6 months to a year. I don't think that you're going to have 17,250 for 2, 3, 4, 5 years. But I think you will have that number posted somewhere sometime.
Excellent.
And part of it has to do with China. With the Shanghai Gold Exchange becoming so prominent and so much of the gold moving to China, I think that at the end of the day, what will decide the gold price is not going to be America anymore. It's going to be China. And the Shanghai Gold Exchange will turn out to be more a bit of a casino type atmosphere. And in that kind of atmosphere, you could see prices well above 17,000.
That's incredible. Sorry I missed the conference. We'll have to tell me about it a little later. So, because it's Silver Week here at Wealthion, and I scheduled you in the middle of Silver Week because you were available, I have to ask you. I have never really heard you talk about silver, but I've read a little bit about some of the things that you've said. What's your view on silver? Is it an important asset?
Well, silver has always been the poor man's gold, as they call it. Okay, and in the last phase of the gold bull market, it actually outperforms gold.
Mm-hmm.
So I think that over the next 4 years, silver is going to do really, really well. You know, as a commercial metal, it has applications. So like people use them actually for solar panel and all kinds of different usage. But also it's used as a monetary asset, but not by the central banks. Okay, like people want to own it as the poor man's gold because it's much easier to buy a silver bar than a gold bar. The price is like a little different.
Mm-hmm.
But it is not per se a monetary asset.
Gotcha. And are you in the slingshot camp? In other words, if you think gold's going that high, there are a lot of people who or silver enthusiasts who think once we get through 50, 100 is, a couple of heartbeats away. In the slingshot concept that it comes up slower, but then it whips out faster.
Yeah, I would not discount it at all. I think that there's a good possibility that happens indeed.
Mm-hmm. Terrific.
As we get closer to embarking and passing behind the seemingly ancient $50 an ounce silver nominal price record, I'm reminded of all the market criminality we've been forced to suffer through ever since 2011's drive-by shooting in Globex hours. The low liquidity Globex takedown of spot silver prices in 2011, marking down negative $5 an ounce in a matter of minutes. Whereas today, there's near no chance a market and the world silver supply deficits being as bad as they have been for the last 5 years running with no end in sight to come. The years of seemingly endless price discovery crimes in the precious metals arena were terribly tough to stay disciplined through. It is with that bitter, sweet taste in my mouth that I make a callback to some of the great bullion bulls of our past who unfortunately did not get to live to see these global bullion bull market days mid-2020s. There are many names and faces who deserve respect laid upon them looking backwards. Even the scapegoated Hunt brothers, whose warped story will again be mistold by the fiat financialized powers that be, but let me remind you here again of the kind of work we do around here, looking back at content we published here 1.5 years ago on this very SD Bullion YouTube channel. This clip is to remind you of actual silver price history, to better arm you with knowledge so that you can take down inevitable Hunt brothers misinformation that will be spewing forth from known next to nothing at all to come. Bloomberg was out this week telling potential silver investors to be careful, siphoning them into short-term unsecured ETF trade ideas instead of actually buying and owning their silver bullion outright. They even took the occasion of March 27, 1980 Hunt Brothers silver bailout as an occasion to pretend they had their facts in order. We're going to pause as they misrepresent what occurred and clear the record, for surely as silver moves back towards 50 an ounce in time, the amounts of sheer scapegoat storytelling fables will become innumerable in fiat financialized media parakeet realms.
All right, today is the anniversary of Silver Thursday, March 27th, 1980, the day the billionaire Hunt brothers met their comeuppance after trying to corner the commodities market. It was one of the zaniest episodes in financial history, seeded all the way back in 1973, when the energy tycoons, Nelson Bunker Hunt and his brothers, Herbert and Lamar, seeking to hedge their oil fortunes from inflation and taxes, began buying silver at around $2 an ounce. And when I say buy silver, I mean buy actual silver. Remember, most commodities traders, they're just buying and selling paper, contracts for the rights to buy something physical. But the Hunts, they wanted that physical bars of silver. They chartered Boeing jetliners to fly the metal to warehouses in Switzerland at least 3 times. Within 7 years, they had stockpiled more than 200 million ounces of silver. That's roughly 2/3 of the privately held supply in the world at the time.
Whether they tried to corner the silver market is still up for debate, and here are some facts, having done years of research on the particular episode in order to learn from their short-sighted mistakes. There was an estimated 12 billion ounces of silver existing above ground at the time. I'm talking about jewelry, antiquities, coins, bars, etc. The Hunts amassed a silver bullion position of some 100 million ounces throughout the 1970s. Their mistake was going leveraged long on the COMEX to the tune of about 150 million representative ounces at the time of the January 21st, 1980 COMEX silver liquidation only rule enforcement, meaning no more going long silver futures contracts. The price could not go higher, only lower. No coincidence, the then price high of both gold and silver followed this COMEX rulebook intervention, and they fell back downwards, culminating into brutal bear markets that lasted more than 2 decades following. COMEX gold and silver traders likely went over to the NYMEX platinum and palladium pits and kicked off a short squeeze there, those prices peaking only a few months later. CPM Group's Jeffrey Christian covered the 1980 Hunt Brothers story firsthand as a journalist back then, and he stated to me in an interview in 2019 that the Hunts likely contributed about 75 cents to $1 an ounce of that exponential silver price move. So according to him, no, it wasn't a cornering. It instead is a scapegoat fairy tale that fiat financialized powers would probably prefer you believe. I mean, use your own critical thinking skills. From 1978 into 1980, the world witnessed a fiat US dollar quadrupling of crude oil prices, a quintupling of platinum prices, a 6-folding of palladium prices, and a gold price spike from $100 an ounce in the middle of 1976 to a then record high of $850 an ounce by January 21st, 1980, an over 8x move. The Hunts had next to nothing to do with the fiat US dollar getting called out by the world's Western financial market at large for overprinting the then exploded fiat US dollar supply outstanding. No, the free market, by sheer fear and greed force, accounted for the fiat US dollar fraud outstanding at the time, as it likely will in some form or fashion yet again.
Prices soared, tripling to $6 an ounce by the end of 1978, then surging to $30 by the end of 1979, peaking a couple weeks later at around $50 in early 1980. On paper, the Hunts had made billions off that trade alone. But in response to the concentrated positions, COMEX and the Chicago Board of Trade imposed an emergency margin requirement that would ultimately break that trade, a trade that by then had become kitchen table talk around America. So much so that jeweler Tiffany took out a finger-wagging advertisement in the New York Times, calling it unconscionable for anyone to hoard several $1 billion worth of silver and depriving folks of having to pay more for baby spoons, tea sets, and photographic film. That ad, it ran on March 26, 1980. The next day, March 27th, came the margin call. COMEX asked the Hunts for $134 million in extra collateral. Now, there are a lot of conflicting reports as to exactly what happened next, but what we do know is ultimately the brothers, who had $4.5 billion in silver holdings, couldn't, or at least didn't, come up with the cash to pay that margin call, so their broker had no choice but to liquidate. That caused prices to crash 19% that Silver Thursday, which still stands as the single biggest daily percentage drop on record. Prices slid 13% more the following Friday, all the way down to $14 an ounce. Fed Chair Paul Volcker, concerned about systemic risk, gave the nod to a group of private banks to lend the Hunts $1 billion to halt the crisis. And there you have it. Wrapped in a bow was the plot line for dozens of magazine articles, Harvard case studies, and lawsuits.
And U.S. Senate Banking Committee hearings, which found the following conflicts of interest. Hearings back then, held by U.S. Senator William Proxmire's Senate Banking Committee, turned up evidence of conflict of interest on the part of members of the then COMEX exchange and possibly certain members of the CFTC also. Based on data provided to the committee by the Commodity Futures Commission trading itself, Proxmire revealed that at least 9 of the 23 members of the Board of Governors of the COMEX were holding enormous short silver positions, which would have required them to deliver more than 38 million ounces of silver bullion worth about $1.9 billion in January 1980, when silver was still near its peak. So no Bloomberg, and much less the CFTC powers that claim to be impartial commodity market regulators, you don't get to rewrite fiat financialized history. We know what you did.
A federal court in 1988 did find the Hunts did attempt to illegally corner the market. That was a ruling that would drive the Hunt brothers into bankruptcy. But they did rebound. While Bunker Hunt was banned from trading commodities, his father's company, Hunt Oil, it did survive, and his brother Herbert became a billionaire all over again after investing in North Dakota shale, and Lamar spent the rest of his years managing his various sports ventures, including the NFL's Kansas City Chiefs.
Finally, as promised, the current short squeeze in cocoa has made the price per ton more expensive than the price per ton of increasing demand but still commonplace copper. For the most part, chart criminals seem to prefer posting shorter-term price history charts in order to elicit social media clicks, like they're pumping some insider crypto coin amongst themselves. Instead, I'd like you to take a look at cocoa prices on a full fiat currency era timeline so you can better understand how gold performed over a similar time frame. Moving in a tenfold fashion, trough to peak during the 1970s, with an interim bear market in between, still five-folding after the fact, cocoa made a major move in the 1970s. And the latest move for cocoa is another five-fold move over a relatively short time frame. But zoom out and let's compare it in terms of gold over the 1970s. Gold ran a more than 20-fold, moving slightly longer in time span than the cocoa move, and no, the world did not end. And the Swiss are still refining gold to ship off mostly to the Eastern world at the moment, and they're still producing some of the best chocolate bars we can hardly afford to buy anymore. The point is, every commodity market from time to time does this bull market blast off. Gold is apparently beginning its final bull market phase that threatens to become a global mania before it peaks out in relative value terms. The financial media at large is still trying to ignore it, which is great. And yeah, the world will likely go on with those holding bullion from here to there, happy they did so prudently with direct ownership. Not surprising, about 4.5 decades too late, the same fiat financialized media is finally admitting that our US CPI price inflation data is rigged far too low, and the truth is that ongoing price inflation, without being masked by technological advancements, has been well worse than what we've been collectively lied to and underpaid to believe. Now, before we roll out and close this week's update, I'm again reminding you out there that are still acquiring physical precious metals positions to visit our website and deals page this weekend to get low silver and gold price premium offerings while supplies last. Visit www.sdbullion.com/deals for this weekend's bullion offerings. And finally, to close, I must remind you that it is very likely in the coming years that slingshot silver will chase gold to the tune of something we once saw in January 1980. A moment in financial history where gold, or the proverbial sweat of the sun, got lunar eclipsed, and the tears of the silver moon for one brief moment outshined gold. Imagine just how many silver tears will be shed if we indeed rhyme in time. $50 an ounce silver will be a pipsqueak joke way behind in our collective rearview mirrors and memories. That will be all for this week's SD Bullion Market Update, and as always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.